We're going to get a little macro here. In 3 acts, inflation has been broken. I think it's safe to say. We're down at 3.3, lower than expected. And hiring and wages are surging and stocks are surging. So let's go through it here and get the Besties' take on the Vibe session.
I actually disagree with that framing, Jason.
Yeah, I agree. I disagree as
You
well.
can disagree with it. Let me go through the numbers and then you can all disagree. That's how this works, folks. Inflation print came in at 3.3%, lower than expected. Here's your 10-year chart. Super easy to explain what's happening here. Rates were low for a long time. Inflation cruising at about 2%. And then lunatic spending during COVID. And we added $8 trillion to the national debt. And then Biden added a bunch, everybody getting those stimmy checks and PPP loans. And so if you look at inflation here, we were just cruising along at 2%. Massive spike up to 9% year over year inflation. And now coming back down to 3.x. And the question is, can we get to a 2 handle? And the rates went up faster than ever in history. Here's the Fed chart. You can see there and this goes from the 80s. So you see that massive spike when they tried to break the back of inflation previously. So this is the fastest ever gone up. And here we go. The common sentiment here is that savings has been burned off and people are starting to have debt. And so now we are in Act 2, the lowest unemployment rate of our lifetime continues. If you believe those numbers, some people do, some people don't. Labor Department reported 272,000 new jobs in May, crushing the 190,000 estimate. And then Act 3, average hourly wages up a massive 4% from last year at $35 an hour. That also topped estimates. So if inflation is at 3.x and hourly earnings are at 4.x, maybe consumers will start feeling better about the economy eventually. They obviously have been pretty shocked by that 9% inflation and only 4% growth. Here's your chart from Fred of the hourly earnings of all employees. And you can feel pretty good about that, where everybody's wages keep going up. The question is, do they go up faster than inflation? Okay, so there's my framing of the situation. Freeberg, tell me what I got right. Tell me what I got wrong.
I think there are 3 numbers that matter.
Okay.
The inflation rate, the growth in GDP, and the cost to borrow. The growth in GDP in the first quarter of 2024 was a lousy 1.3% on an annualized basis. And even if the rate of inflation came down, we are still inflating the cost of everything by north of 3%. So the economy is only growing by 1.3%, and it costs more than 3% more each year to buy stuff. So that means everyone's spending power is reducing, and our ability and our government's ability to tax is declining because the economy is only growing by 1.3%. And the most important fact is that the interest rates are still between 4 and 5%, 4 and 4.7%. That means that to borrow money costs 4.7%, but the businesses, the economy on average is only growing 1.3%. So just think about that for a second. We have a tremendous amount of leverage on businesses, on the economy, on the federal government. That leverage, the cost to pay for that debt, is more than 4 to 5%, but you're only growing your revenue by 1.3%.
Yes.
So at some point, you cannot make your payments.
And the rate and the goal,
and that is true. That is true for consumers. That is true for enterprises, and it is true for the federal government.
Just to point out here what you're saying, the goal was to, in fact, increase the interest rate to cool the economy, right? Which they got too late, but that was the goal. That was the explicit goal, was to cool the economy.
Yeah, the whole purpose of raising rates is to slow the flow of money through the economy. And by slowing the flow of money through the economy, there is less spending, which means that you're reducing the demand relative to the supply. So the cost of things should come down. You should reduce the rate of the increase in the cost of things. Now, if you click on this link, Nick, that I just sent you, in response to the condition in the economy today, Elizabeth Warren sent this note to Jerome Powell 3 days ago saying, "Dear Mr. Powell," or "Dear Chair Powell, we write today to urge the Federal Reserve to cut the federal funds rate from its current 2-decade high of 5.5%. The sustained period of high interest rates is already slowing the economy and is failing to address the remaining key drivers of inflation." She goes on to point out the fact that consumers are suffering, businesses are suffering, and the strain of these 3 numbers is really starting to show on individuals, on businesses, and obviously on the power of the dollar. Well, the dollar is a different story because of the condition of the economy in the rest of the world. And we're in a very unique position. But I think that things are not as rosy. Now, there's certainly a shift in the market because what this tells us is that the timeline at which the Fed will cut rates is coming in a little bit, relatively speaking. And so the market is saying, okay, let's adjust to lower rates. The 10-year Treasury yield has come down a bit. But we are still in a difficult situation for people and for businesses. And you have Elizabeth Warren, who I think is the voice of small businesses and consumers. She's trying to be the voice of those cohort.
That's ostensibly
and saying this is very
so,
hard on people.
Chamath, what's your take on this? We have a slowing GDP growth. We have inflation going from 9 down to 3. We have wages going up 4%. How do you make sense of all this? Do you feel like...
Sorry, Friedberg, are you saying we're going to have stagflation or...
We have stagflation right now, definitely. But what I'm saying is that it's not a rosy picture just because labor rates are going up. If the labor rates aren't going up, and you can see this ultimately, the best number for this is the sum of GDP growth. So in aggregate, if the revenue of everything combined, which is GDP, isn't going up faster than the increase in the cost of everything, people, businesses, and the government can't afford their stuff. And that's fundamentally what's going on right now. What we need to see is a normalization where GDP growth is greater than inflation rate. And as soon as that happens, then we have a more normalized and stable economy. So right now, things are not stable. There's a lot of difficulty and strain in the system.
I will put myself on the other side of that trade, if there was one. If I had to simplify the United States economy, remember, GDP is 70% spending by individual people. And so people can spend two things: savings that they have or credit that they have. And what's interesting is that we have finally burned through, and this is what this picture shows, all of the money that folks had in their bank accounts. And so what does that force people to do? It actually forces people to re-enter the workforce so that they can start to make money. But the problem is that companies have been shrinking and have been on a defensive posture. And so as a result, which you started to see this past unemployment report, unemployment is now ticking up because when these people re-enter the workforce, there are no jobs for them to have. People are filing incremental unemployment insurance claims. States like California, in fact, the state of California was the worst off this past month. So I think what we're starting to see is that for the large portion of the economy, we've run out of cash to spend. And as a result, I do think that we are going to see an economic slowing. And I think that that will create not just enormous empirical justification for Jerome Powell, it'll be exacerbated by what Friedberg just showed, which is the political pressure that he's going to be under to cut. Will it cause him to cut more aggressively than he would have otherwise? On the margins, I actually think yes. Mm-hmm. But my perspective is that I think that we've run out of money, individual people. So I think unemployment is going back up. I think GDP is going to shrink.
Yeah.
And so I kind of tend to be in this camp that we're going to see more than one rate cut.
So here is total job openings. To your point, Chamath, they're getting burned off. We peaked at 12 million. Again, if you believe the numbers or not, they obviously have some value. And we've burned off a ton of those. So Sachs, what's your non-political, non-partisan take, first principles of what's going on with the economy?
Well, look, we just had this inflation report. CPI was 3.3%. The market was expecting 3.4%. So that's a teeny bit better than expected, but it's still persistently sticky. Inflation is. And furthermore, Powell's comments were very hawkish. He basically said he could not commit to when rate cuts might begin. And we're already, remember, at the beginning of the year, we entered the year with expectations for 7 rate cuts this year. Now we're down to an expectation of 1 rate cut, and we can't say for sure when that's going to happen. So honestly, I think your introduction overstated how positive this news was. And that's why I think if you look at the markets right now, it's very mixed. Most tech stocks that I'm seeing are actually in the red, and a few of them like Tesla and Apple and Nvidia are up, but the vast majority are in the red. So I think the market is taking this in stride. I think the big picture here is just we don't know when rate cuts are going to begin. And I think that Vinnie Lingham had a really interesting take on this, actually, where he said, look, could Powell cut by a quarter point? Would that matter that much? No, it wouldn't matter that much. But the point is, Powell doesn't want to say that the rate hike cycle is over, right? If he were to cut by a quarter point, that by itself wouldn't do much, but it would be a huge statement that we're out of the woods on inflation. There's not going to be any more hikes coming, and we're beginning a new rate cut cycle. And Powell is clearly unwilling to say that. We're still in this like limbo where he is saying that we don't know when rate cuts are going to begin.
Betting markets had a 70% chance of 2 rate cuts before Powell spoke. Afterwards, now it's 1 rate cut. Dow, record high again this past week, and NASDAQ record highs each of the last month for the last 4 months. So the market, putting aside individual stocks, has broken records almost every month for the last 3. Freeberg, your thoughts?
On the back of 2 stocks. I mean, NVIDIA is holding up the whole market. There's a lot of funny memes about this.
NVIDIA, Microsoft, and Apple.
The AI stocks are holding up the whole market.
Correct. Yes. Record stock market.
What does Jerome Powell have to gain or lose by bowing to political pressure? So a lot of folks mention and reference his there's political pressure for him to do something. But why would he bow? What does he care? What do you think the motivation is for Powell individually? And what is the political process that will ensue
Future job
if he doesn't
prospects?
bow to political pressure?
I think it's the legacy and the perception that he leaves behind. I think had he not overpromised and underdelivered at the end of last year, remember he was promising, as Sachs said, 6 or 7 rate cuts, and he's delivered bupkis. And the markets were none too pleased. And so now I think he's just swung the pendulum to the other side, which is he's going to massively underpromise and then overdeliver if he can. And so as a result, I think he's being much more measured and guarded. I don't think he wants to be wrong here. So I think he's thinking about what most folks think about when they're at the tail end of a job like this. He's not going to get reappointed. He's going to go off into the sunset. It's roughly about how history will write how he handled the transition from that to the next phase, whatever that is. So I think he's probably very interested in making sure he doesn't break the economy, and also that he doesn't seem like he's constantly waffling and unpredictable.
But isn't he just an autonomous agent that is meant to respond to the data? I guess I'm not quite understanding the degree of judgment and discretion that everyone seems to think he has.
Right, Freeberg?
They have a mandate, but
if you're asking what his incentives are, I agree with Chamath. I think his main incentive at this point is concern for his historical legacy. And specifically, he wants to be thought of like Volcker, not like Arthur Burns in the 70s. Volcker basically crushed inflation even at the cost of a recession, and he is worshipped today as the best Fed chair ever, whereas Burns let inflation slip the leash in the 1970s, and he's not thought of very highly. So I think that Powell's main concern here is with his historical legacy at this point. I don't think he's expecting to be reappointed. He's wrapping up his second term already. Now, I think if you go back to 2021, the incentives were a little bit different. Powell wanted to be reappointed by Biden. And remember that in the summer of 2021, that's when the inflation began. We had that surprise 5.1% inflation print. Powell was up for renomination and confirmation in November of 2021. And I think what happened back in that year is the administration downplayed the inflation report. They called it transitory. Yellen did, Biden did. And so Powell had to get on board with that message if he wanted to get confirmed by the Democrats. And he did get on board with that message. He repeated the whole transitory point. And for that reason, they didn't begin the rate hike cycle until March of the following year. And from that May inflation print to November, they kept doing QE, even though we had inflation back in the system. So I think that Powell was actually intensely political in 2021. He knew who was going to reappoint him and who was going to have to confirm him. And he got on board with that message. And that's why they were so slow to react to the inflation. And I think it was disastrous. And that's one of the reasons why the rate tightening cycle was so steep, is because he had to catch up with all this inflation that he had allowed for 9 months longer than he should have. But if you ask me what's his incentive now, I think it's purely about legacy. And he does not want to let inflation come back after cutting rates a little too soon. So his incentive, I think, at this point is to make sure that he's not wrong again about inflation.
And to remind everybody, maximum employment, stable prices, moderate long-term interest rates is the mandate for the Federal Reserve. They're supposed to be independent. Famously, Reagan pushed Volcker to get rate cuts. And there is a lot of politics involved in this. And so legacy does seem like the organizing principle here. I would agree with Chamath and Sachs that it's legacy, but there's always political pressure here. As you can see, Elizabeth Warren is trying to push him to make cuts for obvious reasons. Yeah.
Well, no, there's politics when they're up for appointment or for reappointment, for confirmation, basically, because they want to get that vote.
Yes.
But
there's also subtle pressure, and then there's letter writing like Elizabeth Warren's doing here, right? So the pressure can be there. The question is, do they bow to it, right, Sachs?
Yeah, they don't have to. I mean, the Fed's independent.
What do they stand to gain or lose by the pressure is my question. And I'm not sure I really like this concept. Exactly. And I think that's really where there's a important point to note here, that you can identify the guy's motivation and how he's going to operate.
This year, because there is no political pressure. There was in 2021, and I think that's why he was slow to react.
Yeah.
Right.
Listen, if Powell can stick the landing here, then his legacy comes out intact. But if he screws this up, and then he was slow to react to the inflation back in 2021 and 2022, his legacy is going to be mud. So I think he's going to be more concerned about erring on the side of tamping down inflation than erring on the side of the economy not doing as well.
Yeah,
I think those are the incentives.
My position is I think he might have already stuck the landing. I think like the fact that we've burned off all that savings, to your point, Chamath, that people are going back to work, and that these businesses are doing fantastic and efficient because of AI and other gains. It feels like all
people are trying.
That I think he's stuck the landing
tech
already.
Stocks that are no.
Yeah, they're trying to go back to work, but the jobs don't exist.
I think they're going to take jobs. They just might get the job they want. And that's what I think people have to recognize, is they have to take a job and they may not be the one that they want, working from home.
We could have a negative recessionary print going into the election cycle. I think that's very possible.
Yeah, exactly.
I don't know, Jason. Look, I'm hearing a lot of happy talk right now. And I agree with Friedberg. You had 1.3% GDP growth rate with a 6% of GDP deficit by the government. If the government wasn't printing so much money, wasn't overspending,
that's right.
If you were to have a balanced budget,
it would be a recession.
Yeah. Think about that. To subtract
it would be negative. It would be negative GDP growth if not for the government's programs stimulating the economy.
And a lot of the jobs you're talking about are government jobs. The government is creating jobs like crazy, not in the private sector, but in the public sector, because it is an election year. So there's a lot of political forces propping things up. And I wonder what happens after the election.